What are the options markets telling us about the rest of 2023? Has the market gotten too complacent, setting us up for a possible market crash? Kris Sidial, a volatility expert, tail risk hedger, and co-CIO of the Ambrus Group, joins me today on the Futures Radio Show podcast. We'll dive into the common misconceptions about trading vol, trading tail risk events, the emergence of zero DTE options, and understanding the relationship between the S&P and VIX. What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. Did you know that with an 81% share and 1.6 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors. Like all Russell US indexes, it's rules-based, transparent, and reliable, regularly updated with the latest IPOs and annually rebalanced. For more information, go to FTSERussell.com. Now, if you're a serious futures trader and you want a powerful platform to match your skills, enjoy flexibility and trading power with TradeStation's award-winning platform. Get 50% off brokerage fees for the lifetime of your account, plus 10% intraday margin rates on 3 popular futures markets when you open a new futures account today at tradestation.com/Anthony. Also at tradestation.com/Anthony, learn about TradeStation's Futures Plus high performance options on futures platform. I've been trading options on E-mini and micro E-mini futures, and it's the best options futures platform that I have used. Check it out at tradestation.com/Anthony. Kris, what's up, my brother? Great to have you on the show.
Yeah, thank you for having me, man. I appreciate it.
I'm excited to have you on. I've been following you on Twitter for some time. I love your stuff. And you and I believe we share the same birthday,
Oh, July 9th,
July 9th, man.
1992 as well, right?
Yeah, 1992. Oh, man, here we go. Yeah, I only got you by a few years. I know it was funny because when I remember, I don't remember which birthday, maybe I think it was just this past year's. And you were like, yo, man, I got the same birthday as you. I was like, man, I knew I really liked this guy. So we're going to have a lot of fun today. What I want to kick it off with is common misconceptions about volatility. What are some of the common misconceptions about volatility that you think everyone should know?
Well, I think there's a lot of them. I think there's a lot of them. The first one is this view that only selling volatility makes money. For what we do, it's something that's very unique. But I think you have this sort of poor stigma that only selling volatility is the only way that you can make money when trading volatility. And there's so many different ways to make money, when trading vol. The other thing that I would say non-derivative traders will have as a misconception is the lack of understanding around vol itself, right? And I think a great example of this was during the whole GameStop thing when you had people buying puts, right? They were buying puts on GameStop. And when GameStop was going down, right? This is January of 2021. When GameStop was going down, you saw a lot of people online, they were commenting and they were saying, well, why are my puts losing value, right? Why am I losing value and the underlying is going down? And that's obviously because the vol that they bought it at was an insane level, right? They were buying these things at like a 400 vol. So there was a lot of that baked in. So I'd say when thinking about just vol in general, there's a lot of these stigmas that are out there that could present itself, but not necessarily, true.
So many people have been following guys like yourself, Jimmy Jude. I don't think that a lot of the people that are following you guys really even understand what trading vol is. Why don't we explain that a little bit?
Yeah, yeah, absolutely. So when you think of traditional let's say traditional asset management applications, right? People have, an understanding that, well, you buy a stock, the stock goes up, you make money. Or you short a stock goes down, you make money. Same thing with futures, right? Same thing with commodities, same applications across the board in almost every asset class that you could think of. Now, when you're thinking about a derivative, specifically like an option, there are other factors that play into this, right? It's a timing component. So you have, your theta. There's a volatility component that is, the vega. That's the implied vol that's inherently baked in, right? And then you have all these other different type of Greeks, delta, gamma. You can get into second order Greeks. But to keep it very simple, when you're thinking about trading vol, you're trying to trade that inherent risk premium that's embedded in the option, right? So it's like if somebody told you, hey, Tesla is going to go up or down tomorrow by 10 basis points. Well, anybody in the market would say, of course, duh. Tesla can move, 20% in a day. It can move 10% in a day. That's very obvious, right? So it's trying to trade that sort of distribution, right? And without nerding out too much, you could think about asset returns and their distribution and trying to trade that sort of spread in between that. So when you think about trading vol, right, it's duplicitous, right? It's like saying, hey, I think that this thing is going to go up further than what the market implies. Or, when I say go up, it could mean go down or go higher. Or I think that this thing is going to move less than what the market implies, right? So generally, guys that are trading vol are trading that sort of risk premium that's embedded in an option from a generalized standpoint, like 101 principles.
Let's talk about 2023. It's been a unique year. They're all unique, right, Chris? So they're none of them are really too normal, right? There's always a unique part about every trading year. But this year, a lot of people are talking about how it is unique because, I mean, look at we've had all these rate hikes. Is it higher for longer? Is inflation here to stay? Is it coming off? I mean, recession was going to happen. Rates were going to be cut. That didn't happen. And so there's just a lot of things I've seen from the macro experts get caught off guard this year. What are your thoughts about 2023 thus far?
Yeah, 2033. I mean, that's the old cliche, right? Everybody's going to be like, it's an interesting year, it's an interesting trading day, which I catch myself doing the same thing, right? So I
I do
can't,
too. I do
I
too.
can't be hypocritical of that, right? But yeah, 2023 has been interesting to the extent that it's been a very long time since we saw the market go down in a very prolonged period and then have such a fast rally, right? What made 2020 so special was that the rebound was immediate, right? So you had the market sell off like 30% plus and big bursts of volatility, and then immediately right after, it just kind of fall back, and the market just obviously continued to rally and turn into an amazing 2021, which was just a huge bull market. The dynamics that are at play with 2023 become even more interesting because you've seen this slow grind down and now this really fast rally, right? But there's so many other moving parts that are very different this time. You have, interest rates going up in an inflationary environment, which, people argue inflation's going down, whatever, right? I'm not a macro trader. What we do is very process driven, right? So when you think about what we do on a day to day, it's following a simple routine over and over and over and over and just exploiting these sort of edges that present itself. So whether the Fed says they're going to raise interest rates tomorrow or they're not going to raise interest rates tomorrow, that really doesn't affect what we do as traders. But when you continually look at the landscape, I think what makes this year so special is how polarized every single move is, right? So the only other market that I can remember that was like this was 2015, where it felt like every 1.5% rally to the upside was met by a lot of people saying, "Here comes the next bull market," and vice versa, right? Every 1.5 rally to the down or sell off to the downside is met by the same thing, where everybody is jumping in. Here comes the next leg down in the bear market. So there's this interesting dichotomy of like this polarization of sentiment where people are very heightened and they think that I'm going to miss the next leg up to the bull market. I'm going to miss the next leg down to the bear market. And the market is just kind of doing its own thing, and shoving off really what the other macroeconomic signals are firing off. And, you have some macro guys and some fundamental guys that would say that equities should be significantly lower. The equity risk premium has been diminished as interest rates go up. But all of that aside, the most amazing thing is that regardless of all of that, equities have been resilient this year. I think anybody would say that, whether you call it a bounce, whether you call it a rally, um, they've been quite resilient with the broad market and what it's been able to do in the face of all this sort of uncertainty.
When I hear you talk about the equity markets being resilient, what comes to my mind is complacency. Because a
Mhm.
lot of times in the past, when I've noticed markets that become resilient, like we're seeing now, and I would agree with you for sure that this market is obviously resilient, it creates this complacency. I mean, we're seeing it. I look at the VIX futures all the time. They continue to go lower. You want to talk about a bear market, just take a look at the VIX futures chart. It just, the thing just keeps going down, right? And so, what is what are the options market telling you right now? Are people complacent? Are they abandoning hedging their strategies right now?
Yeah, absolutely, right. That's the biggest thing, but it's a different type of complacency. And what makes that fixed futures term structure so interesting is that for the last year and a half, the front of the term structure has been dismantled. And people, you're seeing, near dated vol just come in day after day after day after day, right? And then you'll see the market move like 2% or something like that, and vols would just be still deflated, and people are like, "What in the world is going on?" Right? But it's really because people don't think that a near-term crash is likely. But going back to the futures, if you look at how the futures have been reacting, well, the middle of the curve and the back of the curve has been bid, for the last year and a half as well, right? So as the market, and I'm going to try to draw this out with my hands here, right? As we continue to progress in time, the front of the curve is just steeping down, and the back of the curve you see just has this sort of steady bid. And I think that that's because of the whole recessionary theme that's going, or the potential for a recession, right? That theme that's going on in people's mind is that, okay, maybe short term crash is very unlikely, but maybe longer term volatility is more of a likely event. Being that the economy could potentially fall into a recession. Now, from what we do, from a tail risk hedging standpoint. So what we do is we run tail risk strategies for investors, right? But the way how we do it is very different. Traditionally, you see tail risk funds or tail risk managers that just lose money for years and years and years, right? And then you get a pop and fall, and then they get back to flat. That's not really the way how we believe in doing things. The way how we run our book is more so how you would traditionally see on a prop desk, because our background is really as prop traders, right? So like the goal is to be flat, trade through different markets during different conditions, and be flat. But then when faced with this big tail event that occurs, you have this humongous return, right? So normal conditions, your goal is to be flat, but then when a tail event happens, you blow it out. Let's just call it 300, 400% or something like that, right? These really big asymmetric returns. So when we're looking at the environment, an environment where vol, near dated vol, is so cheap, it becomes very, very appealing to us, because those options that we had to inventory at more extreme prices during post the 2020 environment is no longer the case. Now it's like people are very, very inclined to sell you short-term options, and the market microstructure in itself has kind of opened up this other lens for added reflexivity. And I'm trying not to nerd out here. I want to keep this as very general as possible, but like when you think of the growing options market and all these derivatives that are being traded, and how dealer positioning can be offsides, temporarily during these sort of dislocations when they present itself. As a person who, as a tail risk manager, it becomes a very appealing environment for you, because it's like, okay, cool. I get to inventory these sort of, very cheap puts, very cheap, variants, which could be VIX calls, right? And things of that sort. And the market is giving it to me for prices that I'll gladly take, as it continually discounts the likelihood of this event occurring. And I think that that's just a factor of markets in general, right? Like it doesn't matter if it's equity vol, it doesn't matter if it's um, commodities, it doesn't matter if it's trading Coca-Cola cans, right? Or markets will always be markets, and the functionality as to how very discounted things can be blown out of proportion is just a behavioral dynamic. So for us, the vol market continues to hammer down near dated vols, and it continues to be quite appealing.
Maybe this is a stupid question, but I'm going to ask it anyway.
Mhm.
So, because you talk about how there's a bid in volatility farther out in the curve and not right now, does that make the shorter term more vulnerable actually for a crash because people
In
aren't as hedged?
So that's kind of where I'm
What
getting
you're
at. Is that, yeah, yep. That's for us. That's what it feels right. Is the prices that you're getting near dated vol for is insanely discounted for what you have noticed in the past. So like when you think of a VIX at 12, 11, like even single digits at times, right? And or volatile, the pricing of some of these VIX contracts. It's amazing that you can get executed and get the prices of these options that you're getting them at, especially with the fact of how the market, again, the market microstructure has changed significantly over these last few years. So it's like, in our view, and this is, just our view, is that the likelihood of tail events are more likely today than they were 5 years ago because of the growing derivatives market and reflexivity. But the pricing of those sort of short-term tails, the short-term front of the term structure tails are not reflective of that sort of change. So, here's where you kind of get into like, more so theoretical values, and you say to yourself, well, I think that this is, a good environment to be taking down that type of risk, whereas maybe other people may not. But from how we see the market and how we see this, potential for a crash, it's worth inventorying those type of tails. So I guess that's kind of the way how we're seeing things a little bit.
You mentioned 2015 as being a similar year to this year, right? You talked about that a little bit. Does the behavior of volatility we're seeing this year remind you of any other year, or is it just reminding you of what happened in 2015?
Yeah, so definitely I do want to clarify, right? Because 2015 was a year that just kind of ended up like flattish, right? I think the sentiment is kind of the same. Like I remember, being on the desk at that time, and the sentiment, it felt like every couple percent the market was getting ready to go higher, or go lower, right? So it's like everybody was trying to time that, and it feels the exact same way now, where it's like the market will go 1.5% to the downside, and everybody is like, oh, here comes the next leg down, right? So sentiment wise, now the return wise, and what actually happened, from a price perspective, is definitely different, right? Because this year you've had a massive rebound up. In 2015, didn't the market really didn't go anywhere. From a vol standpoint, yeah, this one may get some controversy, but it feels like a 2017, like not as extreme as 2017, but it feels somewhat like 2017, because when you look at 1 month S&P realized vol, I mean, it's market's realizing something around, I'd say, like 9.5 or 10. And when you think of 2017, obviously that number was lower. It was around like 4.5 or something like that, right? But the fact that the actual moves in the market are kind of coming in, contrary to what we saw last year, right? During 2022, you had a couple of days where the market was moving 3.5, 4%, and high to low, those swings were even more rapid than that. This year, it's been more so contracted. So it's not as extreme as 2017. That was an environment where you could have closed your eyes and just short vol and made a ton of money. But it feels like a level underneath that, where it's like, the short vol trade has been working quite well for people. It's almost the same thing. You kind of close your eyes and short vol, it makes some money, and realize vol is not really doing too much either. So that's one market that kind of stands out. Now, if we continue with this sort of price action, maybe it does turn into a 2017 later on in the year. But as of right now, that's one environment that's reminding me of.
How often do we see tail risk events, and can those historical probabilities be used to approximate when we see the next one? I mean, and if so, what type of scenarios do you think could trigger that event?
Yeah, so I think not a lot of people realize this, but over the last 2 decades, you've had a, I would say, what is it, five? You had 20% or more drops in the S&P over a 13-day rolling period, right? So what that means is, on average, every 4 to 5 years, you're getting this sort of 20% decline in the S&P on a 30-day rolling period, right? So that's the other thing that's important. So I would say the likelihood of these tail events, and on top of that too, when you think of the VIX and vol in general, you've had quite a few moments recently where the VIX tapped 50. You've had the flash crash of 2015, right? You've had Volmageddon of 2018. Obviously, you had COVID of 2020, right? So 3 out of the last 8 years, you've had a 50 VIX. So when people think of tail risk events, there's this bad notion to just kind of put it to the side and think, well, that really isn't going to happen. And kind of going back to what I was saying before, that's the beauty as to how markets function, right? It's like, behaviorally, you get people discounting these things and kind of just pushing it to the side. And the market finds a way to kind of get there and remind everybody, just how volatile it could actually be. So from a tail risk standpoint, I would say that these events occur much more likely than people think. When you boil down, and you get more into the weeds of like different asset classes and different single stocks, there's tail events that are occurring every day, right? You see stocks that go up 400 or 500% sometimes. You see derivatives that can return thousands of percent. So these sort of unlikely events occur all the time because markets are non-Gaussian, right? They're an open-ended distribution, not a closed-ended one. So it's a fallacy for investors to believe that this wouldn't occur or these things don't occur. Now, the likelihood of them occurring, this is more so, like a us type of view. We do believe that going forward, if you're used to seeing, let's say, one tail event in every market cycle, we think that you're going to see three, right? Because of the growing options market and some of the other microstructural changes that has kind of presented itself. And the irony behind it is that you get a lot of long vol guys or like tail risk guys that are super perma bears, right? And like we're not of that crowd at all, right? We're really the guys that are really just trading focused. A lot of what we do is a lot of short term prop strats, a lot of heavy on the trading side. So we're not perma bears, but I think we have this view that the changes in the market microstructure has opened up this new avenue for these really big payouts when they occur, and we kind of see it as a way to take advantage of that. So we're not really the guys that are like screaming chicken little, the world is coming to an end, but we do understand that because of these sort of changes, especially in the options market, you can have those type of payouts, and they can happen much more frequently than people think.
Yeah, that's the opportunity that you see in this market environment.
Yeah, yeah, pretty much.
Yeah,
Yep.
I mean, that's what trading is about, right? And I want to go to Twitter because you put a tweet out, and I want to talk about it a little bit. There was recently a lot of buzz and speculation across social media about an article from Bloomberg highlighting a bet on a far out of the money $180 VIX calls, and they were expiring in February. I don't know if you remember this, but can you talk to us a little bit about that?
Yeah, for sure. So this, I guess this kind of goes back to the misconception point that I think a lot of people might appreciate. But, when you see trades like this go on the tape, they could mean a lot of things, right? It could be a guy that's a part of a desk that just needs to hedge off some exposure, right? So this is his like shocks and slides risk. that he needs to make sure that he hedges off. It could be something where, it's part of a bigger deal, right? So you may have some sort of structured products deal that, that you just have this sort of like risk kicker attached. Or you may have a guy that's just outright, speculating on this type of bet, which is generally the more unlikely thing. But when people on Twitter see these type of trades go up, they don't really understand, how it works. So you'll get people saying things like, oh, look at this guy, look at this idiot, right? Spending money on this thing because, he thinks the VIX is going to go to, 200. What a fool. He's losing his money. And you had a couple of veterans like Jimmy, actually, funny enough, comments on it. A lot of respect for Jimmy because of his experience in the space, and every experienced vol trader understands this and gets why those 180 calls will be traded, because when you get a vol event, there's something called a repricing of risk, right? So what ends up happening is, as things are dislocations are occurring and things are not making sense and people are fearful, the market makers naturally start repricing their vol surfaces higher, right? So across the board, they have to refit those vol surfaces. And when you think of a product like VIX, right, effectively VIX is variance, right? So when you think of VIX, you could think of like the cap that you would run on like a VAR swap, right? And again, not nerding out, but think of it as like vol squared. That's effectively what variance is, right? So it's an exponential, like a convex type of payout profile. So, if you're long a vol swap versus long a variance swap, and you have the same type of vol move, the variance swap is going to pay out more because it's that squared component to it. So when you have that, right, just think of like a springboard. Think of like a rubber band that goes like from this to this, right? This to this. And that's the distribution. So when you have VIX, it goes from this to this really fast. And what that means for people who are, maybe not too familiar with like the math behind it, all it means is that the 65 call, the market's going to price very similar to the 85 call, right? And I mean, think about it. If you think of, let's just say Tesla, and somebody said, hey, price me the Tesla, let's say Tesla right now is at 270. And they say, price me the Tesla 270 call, 75 call, and price me the 280 call. Well, you're probably going to be like, well, dude, it could get to 275 and it could get to 280. It's pretty likely that each of those things can happen, like one after the other. Now, if somebody said, price the 270 call and price the 900 call, two different things. But the thing about VIX and variance is that when you get that sort of fear, the pricing across the distribution becomes super flat. So now when you go back to thinking about those options, right, those 180 calls, you realize that, okay, market makers are going to refit their vol surface, you get a repricing of risk, and you have to price in this sort of like vol of all component. Well, those 180 calls that guy is buying for 5 cents can reprice to, $5 with the VIX getting to like 50 or 60, right? So you do the math on that, it's 100 times return that you'll have on this type of option, right? So if you allocate, let's just say, I'm just using this for easy math, you allocate a percent of your capital to something like this and you get 100 times return, right? That's 100% return, on your overall portfolio. So I think where people go wrong is not really understanding, why these bets are out there and really the bets, the purpose that these type of bets serve. And, I hope anybody that's listening, they go back on my Twitter account and look at that, because you'll see some pretty experienced vol guys, comment on that as well, and share their stories, how they've seen things like that. Because in my past, I've seen it all the time. Like I was on both sides of that, right? That's kind of why I'm a tail risk manager today, because I understood the power in these type of trades, when they do occur. So it's really a special thing, when you have those sort of like wingy, 2 cent, 3 cent sort of options that could balloon into this massive payoff.
What is the risk of selling tail options that maybe some traders are overlooking?
Yeah, that's the other side, right? that's the beauty of this sort of trade, because if like let's just go to like sort of how some folks on Twitter are approaching this, right? Which is just like, oh, that guy's an idiot. The VIX will never go to 200. Just lose money. if that was the case, and if that's how options worked, well, selling tails would be the best trade in the world, right? Like that would, that would be absolutely the best trade in the world. All you got to do is just say, okay, pick the furthest strike, sell that, you'll be fine, right? And just allocate, just do it with 25 basis points of your portfolio at a time, right? And then do it across a couple of names. And if the options start moving, then you roll it, right? You roll it out. I can't tell you how many times I've heard things like that, right? You take that and you double the position. Excuse me, you double the position and you roll it. So those sort of applications are really, really poor applications, right? Because effectively that translates into like a non-close-ended distribution where you're martingaling, which at every single moment when you get hit with that fat tail moment, you just completely blow up, right? That's the risk of ruin sort of problem that's presented. And I think a lot of people don't understand that. Early on during my day, as a trader, I experienced that to an extent as well, right? I'd say every guy who's been a vol trader has experienced, or an experienced vol trader has experienced both sides of that. Where one, you have convexity cutting against you and destroying you, and you're looking at it and you're like, what in the world? This option is 200 times, it would take the underlying 200% for the option to get in the money. Why am I down so big on this, right? And I've been on the other side where it's like, oh my goodness, like I've allocated 25 basis points of my portfolio to something like this and I'm up 70%, something insane like that, right? um so these sort of tails, these tail options, they can be very tricky for both sides. But there's nothing wrong with selling options or selling vol, right? Like I'm the first person to advocate for that, which is again contrary to the whole like long vol / tail risk manager thing. You get a lot of guys that are like, oh, selling options for fools, right? When done in a proper manner, they can be a great strategy, right? When you have an edge around doing it, you have some sort of risk defined way, cap structure, and you're able to do that with some sort of discipline. It could be, great. I know a lot of people who, especially on the prop side, have made a living, shorting vol. But then there's doing it without the understanding as to the potential as to what can happen, which is generally what you see during these sort of tail things. And historically, tail selling has generated insane sharps, right? You see people, and every few years you get it, right? You get some hedge fund guy who's like, has a 25% CAGR and, a 3% sharp, and he's the next big thing. And then you're just like, you hear 3 years down the road, oh, how did this guy blow up, right? There's like in every sector, there's always these stories. I don't want to name any funds, or anything like that, but the most famous one, right, is that guy, the optionseller.com guy, right, who was selling a bunch of like calls on nat gas. I think it was nat gas. And then, he blew up, and then he made that video apologizing and all that. He was just made a complete fool of. But yeah, if you're selling options, it's important to understand the inherent risks that do come with it, because it's not as simple as just saying, I'm going to pick the furthest strike and just sell it, and then I'm going to roll it and then roll it. If it was that easy, everybody would do it.
Of course, right? I want to talk about zero DTEs now. Can't have you on here, Kris, and not talk about zero TTEs. So we've seen a massive surge in use of zero DTE options. I mean, everybody's talking about them, right? Ranging from retail traders, market makers. I talked with Jem and Jimmy, and they talked about how institutions are using them now. And it's something that's being used across the trading spectrum. What impact have zero DTE options had on trading vol?
Yeah, I think that's another area in the market that is dynamically changing every few days. I know it sounds crazy to say that, but like every few days, that market, that ecosystem is changing. When we put out that paper, we got a lot of positive feedback and stuff. And for those who want to check out the paper, it's on our website, ambrusgroup.com. But the most interesting thing about the research that we conducted in that was how all the institutions were participating in them. And how aggressive they were to participate in them. And there are a couple of conferences, equity derivative conferences, that have occurred this year where you've had some large institutions. Where I'm not going to name them, but kind of stand up and say like, yeah, we're trading those, and we're selling zero DT options, right? And this is our program, and this is the system that we've applied, and we may not do it in a ton of size, but we're still out there doing it. So I think that is the most interesting thing, to see some of these very larger, sophisticated, or you may not even need to call them sophisticated, but just very larger firms engaged in trading these sort of things. Um, I think the other interesting part about it is the risk that it potentially presents, right? There is a risk that exists with it. And there is a netting effect that obviously occurs with this. So it's not like everybody's completely short, these zero DT options, or everybody's completely long. But as with many things in market, they do have a crowding effect. And if presented in the wrong time, in the wrong moment, the sheer amount of notional exposure and the sheer amount of volume that's traded in these options in a crowding manner can definitely balloon to something much bigger, especially when dealers are caught during one-sided positioning. Um, when you think of like a scenario like March of 2020, that was a scenario where dealers were caught massively offsides, and that's not a subjective take, that's an objective take. I witnessed this firsthand. There's a lot of other traders who saw this firsthand and could attest for that. And you have to think, well, during that time, the option volume, today is like 4x that, during what it was in 2020. And that's because all these exchanges have been, kind of putting out more and more options because people are using them and they're trading them, right? So the amount of options that are traded today are way bigger than during that time. So you have to kind of back into that and say, well, doesn't that mean the netting effect can be bigger, right, during the right moments? Um, so that's the other side to think of, is as that ecosystem continually grows and changes, how does that impact the reflexivity of the broad market? And I think that the final thing that, or I guess, the final thing that we thought was most interesting was that during after COVID, you had a lot of institutions during 2021 that got their option mandates approved, right? So it's like, if like let's say if you were a big pension plan or something like that, once 2020 hit, 2021, you got a lot of approvals to say, okay, now you can trade options. And we see it, right? You have options that are embedded in ETFs and things of that sort. And today, now it's kind of looked at as like everybody has access to the options, right? From an institutional perspective. And that changes the ecosystem, because it's like every day in 2023, it feels like you're getting more mandate approvals continually going through. So it's like a market participant who may be humongous in, just long only equity momentum. Now he gets to participate in this option market. And in what manner is he going to participate? Maybe he's going to say, hey, I want to sell zero DT SPX calls because it fits in my, sort of thing, and it could generate 4% of yield. And then now he just changes the ecosystem and the whole thing, because now this guy's coming in with humongous size selling zero DT, calls on SPX. So when you're thinking about it, it's a constantly changing dilemma. But I think it makes this market even more exciting, especially from a tail hedger's perspective.
Absolutely. I'm thinking about also May of 2010 flash crashes and
Mhm.
become a more likelier probability in this environment. That's what I kind of took from that.
Yeah, yeah. So that's our side. And again, right, I hate to be like the long vol slash tail risk guy that's like, oh, a crash is gonna happen, like perma beer, because we're really not that. But again, when you look at the whole spectrum as to the options market, and then you look at the added reflexivity that could come from something like that, you could totally see how it could lead to down 10% day, down 15% day. Um, that's just our take, right? So.
Yeah. So are there any lesser discussed consequences associated with this widespread adoption that maybe deserves our attention?
Well, I think as with anything, there's good and there's bad with it, right? It's not like these zero DT stuffs are all bad. I think for sophisticated vol shops, it allows them for a cleaner way to hedge off some of their gamma exposure. Uh, there's good applications that exist in the RA community. I think that I guess the problem with that is that like there's another misconception that sophisticated vol shops kind of control the derivative space when that's not the case, right? Like the largest vol shops are like the smallest peons in the bigger ecosystem, right? So like when you think of the guys who are like popular on Twitter, like Jem, Ben Ifer, right, myself included, right? Like I'll speak for ourselves. We're like the small guys in the room when you think of the bigger sort of spectrum. So when you think of like some sort of long only fund that's managing $20 billion in assets, right? They could be a bigger market player in the derivatives space than we are, which means they have more impact in that space than we do. So you get sort of like unsophisticated applications of these sort of bigger participants that are engaged in this, which for what we do can be beneficial because it's like you get favorable pricing in certain areas, right? So I think it's allowed for a better sort of trading environment for people who are very active traders. And I think that it's allowed a cleaner way for sophisticated vol shops to sort of hedge out some of their risk, some of their slide risk. So I'd say overall, I guess the I guess the gambler in me is excited and I'm happy. Like I would rather zero DT options being traded, especially because the opportunities that they present, than them not being traded. So I think that's kind of the way how I look at it.
Let's talk about the market's relationship with volatility, the VIX, S&P and VIX. You hear so many traders say, well, if the VIX goes down, the S&P should go up. I've seen scenarios where they've moved together. Talk
Mhm.
to us about what that means when they are moving together.
Yeah, that's a very very good question because there's a lot of things that could mean, and there's a lot of things that may not mean. I think of September of 2020 when you had the whole Masa Son thing, where he was coming in, SoftBank was coming in and buying a ton of these tech calls, and the market was raging to the upside. And at the same time, VIX futures were also going up because the dealers who were on the other side needed to hedge off the exposure by buying VIX futures. And there was kind of no other market that they could get in and hedge that exposure off. And you had that dynamic of vol up and spot up, right? And that was very confusing to a lot of people because it's like that dynamic of that risk premium, can't stay consistent because, I mean, think about it. Imagine like getting paid to have like a free hedge, right? That's effectively what that is, right? If you're a person in the most vanilla way, you're buying the stock market and then you're making money, on the hedge for the stock market. That's that sort of break in that volatility risk premium that's there, right? So I think sometimes people might overanalyze the smaller moves where you get like spot up, vol up, because at times there's like systematic rebalancers that will come in and they'll do things like be forced to buy seasonality fall and things like that, and you may see, oh shoot, why is the market up 50 basis points today and VIX futures are also up like a vol point. And that's because as the market is going up higher, these people need to rebalance their hedge, right? So they may sell off some front run stuff, they may buy middle of the curve, or vice versa. Maybe they're getting out the middle of the curve stuff and buying their nadir stuff as they increase exposure. So there's multiple reasons as to why you could see spot up and vol up, and there's also multiple reasons why you can see spot down and vol down. And I think 2022 was a great reminder to people that that dynamic exists, and it's a real thing to consider, right? So when again we go back to the beginning of this podcast, talking about like why vol is so important, right? If you're buying an option, like let's say a put on the S&P, um, and the vol that you're buying is now stating that the implied move in the S&P is 2.5%, and then you wake up the next day and the market's down 1.5%. Well, there's a reason why you're not getting paid on that option because you did not the realized move did not catch up to what the implied move was seeing, right? And I think that during 2022 you had a lot of that. You had a lot of sort of baked in fear and baked in sentiment based on inflation and on a lot of other macro thematics where equity vol was not high, right? It wasn't really high, but it wasn't really low either. It was sort of like in that middle ground. And then, people were kind of disappointed because they're like, why is vol not following through? And it's really because you didn't get that sort of fear and panic or that sort of realized move follow through. So, when you're thinking about trading vol, um, you know, it could be complex because it's like there's all these sort of idiosyncratic things that kind of present itself. Whereas like you buy stock, you buy Apple, and it goes up tomorrow. I'm all right. I'm making money on my Apple position, right? Short Apple, it goes down tomorrow. I'm making money on my Apple position. But with options, some of the pricing and the way how those things work from a vol perspective, obviously it adds some additional factors of consideration. So when people are trading options, you really have to take into account what is the vol and what does that look like.
Yeah, I can attest to that. I've been a futures trader for almost 25 years, and over the last, I would say, several years, I've been inching my way more and more into options. And it is really like learning a whole new language within the language that I've already known of trading. It's it's
Mhm.
it's not the same. Just because I've been successful at futures, in no way did that mean I was going to have any success in trading options. It is learning something very new. And you're one of the best people I have found to actually explain things so people like myself can understand. And that brings me to the Ambrus Group. Obviously, I'm a big fan of yours, and I've seen you continue to grow on Twitter. You see people continuing to share your stuff. I mean, you do great things on there for traders and investors on social media. Explain to us why we should come to the Ambus Group and use and look to you guys.
Oh, yeah, that's an interesting question. So what we do is yeah, obviously we're again a tail risk manager, right? So we don't really we put out research just because we like doing it and we think that people get value from it. But the nature of our business is, I run a hedge fund, and then we also have like custom SMA stuff on the side. Um, but really, when you think about what we do from a manager's perspective, I think it's something that's very unique in this space because our roots are really as prop traders. I've been on a couple of different desks throughout my career, and so has my partners. And what we've experienced on these desks is really a love for this side of tail risk hedging slash long vol, but also we've witnessed just poor applications of it. So when you think of when you think of tail risk hedging, there's this very bad notion that, or this very bad stigma that goes with it, where it's like, yeah, these guys just bleed for years and years and years, and they don't make any money. Whereas on the prop side, I've seen guys have really really good books where it's like they stay flat, or maybe they make a little bit of money during normal conditions, and then when things are really dislocated, they shoot the lights out, right? And that's sort of the model that we kind of, the business model that we really have over at the team, right? So it's like as potential investors or our current LPs, we're not bleeding out their money, right? So in a year like this year, right, where other long ball guys are like down money, right? That's not really how it looks like for us. So I'd say, when hopefully we're changing the way how people look at tail risk hedging and long vol in general, to look at it more from a real trader's perspective as opposed to this sort of like asset manager passive sort of just buy puts and roll and roll and roll and just hope for the blow up of the world. So that's kind of what we do. But from a research standpoint, we've kind of been taken back that people have enjoyed the research so much, obviously because we have a hedge fund that like we're trying to we have to stay competitive, so we don't put out all of our research. A lot of the stuff remains in house, but it is fun when there's like a topic that comes up, to put out some stuff to get the public to kind of have an idea. And yeah, we're blown away that so many people appreciate the research like that. So, we're just gonna try to keep it going.
Well, I appreciate the research and I appreciate you, Kris. This was extremely insightful. I've learned a ton from you on Twitter, learned a ton from you today. I hope people go and follow you on Twitter. Tell everybody your Twitter handle and also the website to learn more about you guys.
Yeah, so my Twitter is KSIDIII. So you can just type me in, Kris Sidial. And the website is theambrusgroup.com.
Everybody go check it out. Kris is the real deal. And two good-looking guys born on July 9th. If there's one thing I know, July 9th pumps out some good blood, buddy. This was a pleasure, man. Thank you so much for joining me today.
Absolutely. Thank you for having me, brother.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.